Washington believed the storm had passed. After months of escalating tensions, threats, and economic disruptions, officials thought they had finally secured a trade agreement that would reset the balance with Beijing. Treasury Secretary Scott Bessent appeared on television screens across the nation, his tone confident, his message clear. America had won. The deal was a strategic triumph, he insisted, a turning point in the competition for global economic dominance. But if you listened closely, something didn't add up. Behind the polished rhetoric and the carefully chosen words, there was an unmistakable sense of unease. The reassurances felt too emphatic, the victory claims too loud. And that raises a troubling question. When a government declares success this aggressively, what are they really trying to convince us of? The truth is far more complicated than the headlines suggest. What appeared to be a diplomatic breakthrough is beginning to look more like a strategic miscalculation, one that could reshape the global economy for decades to come. Because while Washington celebrates, Beijing is quietly demonstrating something that should concern every American. The power dynamics haven't shifted at all. Only the perception of who holds the advantage has changed. This is the story of how a trade deal became a symbol of America's deepening vulnerability, and why the materials that power our modern world have become the most dangerous pieces on the geopolitical chessboard. When the full text of the agreement between Washington and Beijing finally emerged, analysts on both sides of the Pacific immediately noticed something strange. The Chinese government's official announcement was remarkably brief, a few paragraphs emphasizing collaboration, market predictability, and shared interests. The language was diplomatic, even vague. There were no specific quantities mentioned, no concrete timelines, no measurable commitments that could be tracked or verified. The American version of the same agreement told an entirely different story. U.S. officials released documents filled with precise figures, detailed milestones, and explicit targets for trade volumes, export controls, and bilateral cooperation. It read like a comprehensive roadmap with checkpoints and deadlines, the kind of agreement you'd expect between two nations trying to build accountability into their relationship. But here's the problem. Beijing never confirmed any of those numbers. The two governments weren't just emphasizing different aspects of the same deal. They were describing two fundamentally different agreements, as if they had negotiated in parallel universes and then walked away believing they'd signed the same document. This isn't just a matter of diplomatic interpretation. It reveals a fundamental mismatch in objectives and expectations. Take rare earth elements, for example. The specialized minerals that are absolutely critical to everything from smartphones and electric vehicles to advanced weaponry and renewable energy infrastructure. The agreement stated that China would grant general export licenses to facilitate trade. On the surface, that sounds reasonable. But the text never specified how much American companies would actually be allowed to purchase. Would U.S. manufacturers be able to import enough to build strategic reserves? Or would Chinese suppliers retain the authority to decide, case by case, how much material leaves the country? No one in Washington could answer that question with certainty. And that ambiguity is precisely the point. Another section dealt with synthetic opioids and the tariffs imposed on Chinese products linked to the fentanyl crisis. The U.S. government publicly claimed victory, announcing that cooperation on interdiction efforts had improved. Yet at the same time, Washington quietly reduced the punitive tariff on fentanyl-related imports from 20% down to just 10%. If the goal was truly to choke off illegal flows and punish producers, why would tariffs be cut in half? The logic doesn't hold together. Then there's agriculture, a sector that American officials have repeatedly promised would benefit enormously from better access to Chinese markets. U.S. farmers grow some of the most productive wheat, corn, and beef in the world. But China continues to source the vast majority of these products from South America, particularly Brazil and Argentina, where production costs are lower and shipping distances shorter. When it comes to soybeans, a crop that American farmers depend on heavily, Beijing offered only a general pledge to expand agricultural trade. No tonnage figures, no delivery schedules, nothing enforceable. That kind of promise is essentially meaningless. It's the diplomatic equivalent of saying we'll stay in touch after a first date. Polite, non-committal, and easy to forget. The most troubling aspect of this agreement isn't what it includes. It's what it lacks. There are no enforcement mechanisms, no automatic triggers if one side fails to meet its obligations, no if-then clauses that create predictability. Washington wanted a rules-based framework with accountability baked in. Beijing wanted flexibility, room to maneuver, and the ability to adapt as circumstances change. That fundamental imbalance now defines the entire relationship between the two countries, and it's already causing frustration and confusion in Washington, feelings that are only going to intensify as the reality of the deal becomes impossible to ignore. Scott Bessent has become the most visible defender of the Trump administration's economic strategy. Over the past several weeks, he's appeared in interviews with major media outlets, arguing that Beijing made a serious error by restricting rare earth exports earlier this year. According to Bessent, China miscalculated badly, and that mistake has given the United States unprecedented leverage. But when you examine the details, his confidence starts to look less like genuine optimism, and more like an attempt to control the narrative. Because the evidence suggests that China hasn't lost any leverage at all. If anything, Beijing is wielding its economic power more strategically and more effectively than ever before. In a lengthy conversation with the Financial Times, Bessent outlined what he called America's new approach to global trade, Fortress America. The strategy is straightforward. Pressure U.S. allies in Europe, the United Kingdom, Australia, Canada, and Japan to raise their own tariff barriers against Chinese goods. The goal is to build a coalition of democracies that can collectively reduce dependence on Beijing's industrial base. Bessent pointed to statistics showing that America's trade deficit with China has fallen by roughly 25% this year. On the surface, that looks like progress. It suggests that the tariffs are working, that U.S. policy is successfully redirecting trade flows away from China. But dig beneath those numbers, and a very different picture emerges. Global trade patterns are shifting, but not in the direction Washington intended. The tariffs aren't isolating China. They're pushing American allies closer to Beijing's orbit. From Berlin to Tokyo, manufacturers are buying more Chinese components, not fewer. Why? Because there's simply no alternative that matches China's combination of price, quality, and reliability. European industries, still reeling from the loss of cheap Russian natural gas, can't afford to cut ties with Chinese suppliers without driving their own production costs to unsustainable levels. Asian supply chains, meanwhile, have been integrated with Chinese factories for decades. Severing those connections would require a complete restructuring of regional trade, something that would take years and cost trillions. Even countries that are nominally aligned with Washington's strategy are hedging their bets. They publicly support the rhetoric of decoupling, but privately, they're maintaining and even expanding their commercial relationships with China. Because the hard reality is this: you can't run a modern economy without access to Chinese manufacturing, Chinese technology, and Chinese resources. Bessent's narrative ignores this fundamental truth. He talks about overcapacity in Chinese industries, about unfair subsidies and market distortions. And he's not entirely wrong. Those problems are real, but the rest of the world isn't waiting for Washington to solve them. Instead, governments and corporations are adapting to a global economy that increasingly revolves around China, whether the United States likes it or not. The harder Washington pushes, the more its allies question whether following America's lead is in their own best interest. And that's the fatal flaw in the Fortress America strategy. You can't build walls fast enough to contain an economy that's already embedded in every major supply chain on the planet. Bessent can deliver confident speeches on television. He can cite statistics that sound impressive, but he can't change the basic mathematics of global trade. The G7 nations cannot decouple from China without crippling their own industries. And deep down, everyone knows it, including Bessent himself. Act 3. The long game and the short attention span. When asked whether China operates with a long-term strategic vision, Donald Trump responded with a revealing answer. We play the long game too. But the question isn't whether America can think long-term. The question is whether it actually does. In the United States, presidential elections happen every 4 years. Congressional control can flip every 2. Every new administration brings new priorities, new policies, and often a complete reversal of the previous government's approach. That's democracy in action. But it's also a fundamental weakness in any long-term competition with a rival that doesn't face the same constraints. Beijing understands this better than anyone. Chinese leadership can plan in decades, not election cycles. They can invest in infrastructure projects that won't break even for 20 years. They can nurture industries that won't dominate global markets until the next generation. And they can wait out political changes in Washington, knowing that today's trade war might be tomorrow's diplomatic reset. This is the structural reality that Scott Bessent is trying to obscure with his confident rhetoric. And even Trump himself has acknowledged how profound the challenge really is. In a recent interview, the former president was confronted with sobering intelligence assessments. Chinese cyber operations have penetrated parts of America's electrical grid and water infrastructure. Beijing-linked entities continue to acquire farmland across the United States. Chinese intelligence services systematically steal intellectual property and personal data from American citizens. Trump's response was surprisingly candid. He acknowledged the threat, but framed it as a natural part of great power competition. We're a threat to them too, he said. Many of the things you say they do, we do to them. It's an answer that captures America's strategic dilemma perfectly. Washington recognizes the danger, but treats it as an endless game of move and countermove, a competition without resolution, where neither side can ever truly win. Bessent has positioned himself as the administration's chief spokesperson on economic policy. In interview after interview, he insists that America is finally waking up to the China challenge. He describes a clear plan to break free from Beijing's control, supported by a new alliance of Western and Asian democracies moving forward at unprecedented speed. The U.S. has been asleep at the switch, Bessent said in one appearance. Now this administration is going to move at warp speed over the next year or two. We're going to get out from under this sword that China has over us, and they have it over the whole world. This time, we've rallied the allies. All the Western democracies, the Asian democracies, and India are going to join us in forming our own supply chains. It's an inspiring vision, bold, ambitious, and completely disconnected from the practical realities of industrial policy. Because building alternative supply chains for rare earth elements isn't something you can accomplish in 1 or 2 years, no matter how much political will you can muster. Every stage of the process is wrapped in layers of regulatory approval, environmental impact studies, and local opposition. Even if the federal government threw unlimited money at the problem, you can't speed up geology. On average, bringing a new rare earth mine into full production takes approximately 10 years. Building a refining facility capable of processing those materials takes another 5. And that's assuming everything goes according to plan, which in the mining industry it almost never does. There's another complication that Bessent conveniently overlooks. The vast majority of global expertise in rare earth extraction, processing, and refinement is concentrated in China. The engineers who know how to separate these elements efficiently, the chemists who understand the complex reactions involved, the technicians who can maintain the specialized equipment, most of them are Chinese nationals, and many of them are now subject to what analysts have started calling an intellectual embargo. Beijing has quietly made it much harder for this expertise to flow westward. Even if America manages to construct new facilities, who will operate them? Where will the knowledge come from? You can't download decades of industrial experience from the internet. Bessent talks about Operation Warp Speed for rare earths, as if it's just a matter of national will and financial resources. But unlike developing a vaccine, where you're accelerating something that's scientifically possible, rebuilding an entire supply chain from scratch requires overcoming fundamental physical and logistical constraints. To pull off what Bessent is promising, you'd need something beyond resources and determination. You'd need to rewrite the laws of economics and geology. And even then, time would still favor China. Act 4. The hard numbers don't lie. According to projections from the International Energy Agency, Chinese companies will maintain control over approximately 60% of global rare earth mining through the end of this decade. Their dominance in refining is even more overwhelming. Roughly 70% of all processing capacity worldwide. But those aggregate numbers don't capture the full picture. When you look at the 4 most critical rare earth elements used in high-performance magnets, neodymium, praseodymium, dysprosium, and terbium, China's position becomes nearly unassailable. These materials are essential for electric vehicle motors, wind turbine generators, advanced military systems, and countless consumer electronics. And for at least the rest of the 20s, Beijing will remain the dominant source for all of them. This isn't just market leadership, it's the foundation of the entire modern industrial economy. Every electric car, every offshore wind farm, every 5th-generation fighter jet, every data center powering artificial intelligence, they all depend on materials that flow through Chinese refineries at some point in their supply chain. Even if the United States and its allies commit hundreds of billions of dollars to developing alternative sources, the economics still don't work in their favor. Chinese refineries benefit from access to heavily discounted Russian energy, a crucial advantage ever since Western sanctions pushed Moscow and Beijing into closer economic alignment. They also source commodities from global markets where China's massive purchasing power keeps prices low. No Western producer can match those structural advantages. That means building competitive rare earth refineries in the United States or Europe would require accepting costs that are dramatically higher than anything Chinese firms pay. Industry analysts have calculated that for every dollar of output, Western producers might have to spend $2 in inputs. That's not a sustainable business model. It's economic self-sabotage. And if Beijing decides to retaliate by tightening export controls again, the consequences would be severe and immediate. The last time China imposed restrictions on rare earth exports, back in 2010, during a territorial dispute with Japan, European buyers saw prices spike by as much as 6 times their previous levels. American companies struggled to secure any materials at all. Meanwhile, inside China, prices remained relatively stable. Domestic companies and end users continued paying roughly the same rates they always had. This is why Scott Bessent's optimism sounds so detached from reality. Beijing doesn't just dominate rare earth production. It controls the entire global pricing mechanism. When Chinese policymakers adjust export quotas, the ripple effects are felt in every manufacturing hub from Detroit to Stuttgart. And that's a form of leverage no Western alliance has been able to counterbalance. The deeper Washington commits to its Fortress America strategy, the clearer it becomes that China still occupies the strategic high ground. And no amount of confident speeches can change that fundamental imbalance. Act 5. The fragile foundations of growth. Scott Bessent continues to assure financial markets that the American economy is fundamentally sound. But even he can't avoid acknowledging that significant parts of it are already contracting. Inflation remains stubbornly above the Federal Reserve's 2% target, and the cumulative damage from recent tariff escalations is beginning to spread through the system. Since the latest round of trade restrictions began in April, consumer confidence has declined every single month. Household expectations for future economic growth have collapsed. Americans are cutting back on discretionary spending even as prices for essentials like food, energy, and housing remain elevated. When a journalist pressed Bessent on whether the United States is at risk of entering a recession, his answer was carefully calibrated, but revealing nonetheless. "Do you agree that the U.S. is at risk of facing a recession?" the interviewer asked. "I believe we are in a transition period," Bessent replied. "But do you think the U.S. is at risk if the Federal Reserve doesn't continue cutting interest rates?" "I think we are in good shape," he said, pausing slightly. "But there are sectors of the economy that are in recession. The Fed has caused a lot of distributional problems. Those measured words confirm what economic data has been showing for months. Parts of the American economy are breaking down. Job growth has slowed dramatically, with a wave of layoffs hitting the technology sector particularly hard. Many companies have frozen hiring plans or moved production facilities overseas to avoid higher import costs. Meanwhile, portions of the federal government remain shuttered due to budget gridlock, delaying contracts and freezing spending across multiple agencies. Every new tariff adds more pressure to an economy already operating on historically high levels of debt and financial speculation. The only sector generating genuine excitement is artificial intelligence. Bessent calls it America's new growth engine, and in the short term, he's right. During the second quarter of this year, AI-related investment alone contributed 1.6 percentage points to U.S. GDP growth. That's an extraordinary figure, driven primarily by massive construction of data centers and surging demand for advanced semiconductor chips. Wall Street analysts are predicting that this trend will continue, potentially offsetting weaknesses in other areas of the economy. But here's the uncomfortable reality. That entire boom depends on Chinese rare earths, the specialized materials required to manufacture high-performance chips, the magnets in advanced cooling systems, the components in power infrastructure. They all trace back to supply chains that run through China. And those are exactly the supply chains caught in the middle of Trump's trade confrontation. Imagine the U.S. economy as a towering Jenga structure. Tariff policy, rare earth access, and artificial intelligence are three critical blocks near the foundation. Remove just one, and the entire tower starts to wobble dangerously. That's why Bessent's optimism feels so precarious. America's short-term growth depends on a technology revolution built on Chinese resources, even as its consumers struggle with rising costs and deteriorating job security. The foundation may appear stable for now, but every new policy shock, every escalation in trade tensions, makes the entire structure more vulnerable to collapse. Act 6. The dollar's dilemma and the reckoning ahead. To finance its ambitious effort to rebuild critical supply chains, Washington will have to rely on one fundamental tool: debt. The federal government is already running trillion-dollar deficits, and Scott Bessent has hinted that a new wave of liquidity is coming, what economists are calling a tsunami of cheap credit designed to keep the economy expanding. In practical terms, that means printing more money and borrowing more aggressively to fund everything from infrastructure projects to industrial subsidies. Cheap credit can provide short-term relief for corporations and consumers who are struggling with high costs. But it also comes with a dangerous side effect. It erodes the value of the dollar itself. The U.S. dollar isn't just another currency. It's the foundation of American global power. For decades, the dollar's status as the world's primary reserve currency has given Washington an enormous advantage: the ability to finance massive deficits without facing the same consequences that would crush other nations. Foreign governments hold dollars as savings. International trade is conducted in dollars. That demand keeps the currency strong and keeps borrowing costs low. But that privileged position depends on trust. And every time the Federal Reserve cuts interest rates to stimulate growth, every time the Treasury issues more debt to fund new spending, that trust erodes a little bit more. Lower interest rates make borrowing easier, but they also make holding dollars less attractive to foreign investors. The same policies that provide short-term economic relief gradually undermine the long-term foundation of American financial power. Bessent's entire strategy depends on maintaining access to unlimited liquidity, but the world is already looking for alternatives. Central banks in Asia, the Middle East, and even parts of Europe are quietly diversifying their reserves, holding more gold, more euros, more yuan. They're not abandoning the dollar entirely, not yet, but they're preparing for a future where it might not dominate the way it has for the past 70 years. China, meanwhile, isn't standing still. Beijing is systematically reinforcing trade relationships across Asia, Africa, and Latin America. It's deepening energy partnerships with Russia. It's building financial infrastructure that allows countries to conduct trade without relying on dollar-denominated transactions. Every new agreement, every new partnership, strengthens a parallel economic system that can function even if the dollar weakens significantly.